Forget everything you thought you knew about filing your taxes, because 2026 is about to flip the script on millions of Americans in a way that most people aren't even talking about yet. We're heading into one of the biggest tax cliff moments in modern history. And if you're not paying attention, you could leave thousands of dollars sitting on the table. Here's what's actually happening. The Tax Cuts and Jobs Act of 2017 is set to expire at the end of 2025. And unless Congress acts, the standard deduction is going to shrink dramatically starting in 2026. That one shift alone could change whether itemizing your deductions suddenly makes financial sense again for the first time in nearly a decade. So let's back up and explain the game, because the whole thing runs on one beautifully simple idea. The IRS doesn't care when something happened, only when you paid for it. That means you have more control over your tax year than your accountant might have ever told you. Bunching deductions is the strategy where you deliberately stack 2 years' worth of deductible expenses into a single tax year to blow past the standard deduction threshold. Think of it like saving up your loose change all year and then dumping it on the counter at once, instead of spending a little every day and never having enough for anything. Now here's the irony that makes this almost poetic. For most of the last 8 years, bunching was basically irrelevant because the standard deduction was so high that ordinary people couldn't touch it. We were all essentially pre-opted out of itemizing, handed a flat rate, and told to be grateful. But the mood has shifted, and the numbers are shifting with it. If the standard deduction drops back toward pre-2017 levels, we're talking about potentially tens of millions of taxpayers suddenly finding themselves in itemizing territory again for the first time since the Obama administration. History actually gives us a pretty clear playbook here, because this isn't the first time the tax code has swung like a pendulum and caught everyday people off guard. Back in the 1980s and 90s, sophisticated investors and even middle-class homeowners routinely bunched charitable contributions, medical expenses, and property taxes into alternating years to maximize their deductions. Now let's kill the biggest misconception right now, because a lot of people hear bunching and assume it's some shady loophole for the ultra-wealthy. It's completely legal, explicitly supported by the structure of the tax code, and frankly, the IRS built the system in a way that makes this not just possible, but almost logical. Donor advised funds are one of the cleanest tools in this whole strategy, because they let you dump a large charitable contribution into the fund in one tax year, claim the full deduction immediately, and then distribute the money to actual charities over multiple years. You get the tax hit when it helps you most, not when the charity happens to send you a thank you note. The practical checklist here is actually pretty short. Accelerate deductible expenses like dental work, property tax prepayments, or large charitable gifts into your high deduction year, and then coast on the standard deduction in the off year. The discipline isn't in the strategy itself, it's in resisting the urge to just do what you always do when the calendar flips to January. And yes, there's a real behavioral trap here, because most people make financial decisions on autopilot, paying bills when they arrive and donating when they feel moved, without any strategic awareness of which tax year they're feeding. The gap between someone who plans this and someone who doesn't isn't intelligence, it's just intentionality. Let's be honest about the uncertainty too, because Congress could extend the current provisions, modify them, or do something entirely unexpected in a classic government fashion. But even if nothing changes, running the math on your own deductions right now costs you nothing and could reveal an opportunity that's been sitting invisible in your own financial life. The philosophical point here is the one that actually matters most. Tax strategy isn't about outsmarting the system. It's about understanding the system well enough to make rational decisions instead of emotional or accidental ones. Discipline, consistency, and a little planning will always outperform panic filing in April with a shoebox full of receipts. You don't need to be wealthy to play this game smartly, and you don't need to be afraid of 2026. You just need to look at your own numbers with fresh eyes before the window closes. Whether the law changes or stays the same, the people who prepared will always be better off than those who waited. And if you're ready to take that same energy into building real wealth, whether through real estate investing, home contracting projects, or finding the right lenders to back your next move, check out the links in the description below and let's get you started.